Now, the pound lowered today after UK retail sales data unexpectedly fell in December. That adds to bets that the Bank of England will cut rates at Governor Carney's last monetary policy meeting this month. The market reckons there is now more than a 70% chance of a cut. We're back with David Stubbs from JPMorgan Private Bank. All right, we had a policy speech by Mark Carney, which, if you read it, was actually a lot less, I would say, dovish than the markets took it. Then we had a number of other MPC members. Then we had some disappointing data. And there you go. Money markets are expecting a 73% chance of a rate cut January 30th. Are they wrong?
Well, it's certainly possible that the Bank of England could move in January. We have some other crucial data between then and now, and if they are negative, then potentially there'll be a majority on the committee to cut. I don't think it'd be a unanimous decision, but obviously this is a majority-based committee system. I think the Bank of England is nervous about using up its limited firepower for kind of traditional policy before going back to unconventional measures. But, they absolutely would not want to get behind the economy if it looks like there's a recession coming, and they would probably want to at least do something modest and then hope, and with a very good reason, that the budget that's coming from the new government would be a very powerfully stimulative one. And if the data continues to slide at this, I think that the new government would throw the kitchen sink at the economy.
What kind of budget does the UK need right now?
Well, obviously the focus has been on long-run government spending to level up the rest of the economy. That's been the narrative. But that takes a long time to build out transport, improve education, etc. There's obviously the pledges on healthcare for the NHS. But if the government is facing actually a cyclical downturn, they're going to reach for tax cuts. I would suggest potentially a cut for stamp duty to try and get the housing transactions going. It's very powerful stimulative there. Other Conservative governments have used that in the past. And potentially income tax cuts or national insurance cuts to the lower income parts of the workforce, and that would help them with their narrative in the north of England and the Midlands, the seats that traditionally Labour that voted for them. They say, look, we're trying to help you in the medium term, short term, we put more pounds in your pocket.
But what does that mean for deficit? So if you're what does it mean for gilts, and what does it mean for actually a pound trader?
Well, I think the deficit is likely to expand. I think it's likely to expand from their medium-term spending pledges, let alone any tax cuts to deal with with this potential slowdown that we're seeing right now. So the deficit was going higher, and Francine, I don't think the market gives a damn about the budget deficit. Not for an economy with your own central bank, your own currency, your ability to do QE. We see huge deficits in America, market doesn't care. Huge debt levels in Japan, market doesn't care. It might push the pound down, certainly if we have this continued slide in data. But I think most market participants would, if they're worried about the performance of the UK corporate earnings there, they're going to welcome robust policy support, whether it comes from the Bank of England or whether it comes from the budget.